After the age of 60, the Australian tax and superannuation system quietly unlocks a set of financial advantages that most Australians either don't know exist or know about but never actually use. Some of these are worth thousands of dollars a year. Some are worth tens of thousands over a retirement. And every single one of them is completely legal, fully sanctioned by the ATO, and available to you right now. The problem is, nobody tells you about them clearly. They're buried in legislation. They're mentioned in passing by financial advisors who assume you already know. And they're written about in government documents that are designed to be comprehensive rather than readable. Today we're going to change that. 7 specific things, all ATO approved, all available after 60, that most Australian retirees are simply not using. By the end of this video, you'll know exactly what they are, how they work, and what to do to access them. The first thing the ATO allows you to do after 60, that most people either forget or never knew, is this: access your super completely tax-free, not reduced tax, not concessional tax, zero tax, on every dollar. Before age 60, when you access your superannuation, you pay tax depending on your age and the components of your super balance. The taxable component of your super, which for most Australians is the majority of it, attracts tax when withdrawn before 60. The rates vary, but they are real and they add up. After your 60th birthday, that changes entirely. Any superannuation withdrawal, whether it's a lump sum, a pension payment, or a regular income stream, is completely tax-free. Every dollar that comes out of your super after 60 is yours. The ATO takes nothing. What this means in practice is significant. If you're drawing $60,000 per year from your super in retirement, all $60,000 is tax-free income. You won't pay $1 of income tax on it. And because it's tax-free, it doesn't even need to be declared as assessable income for most purposes, which flows into the second thing most people miss. The second ATO advantage after 60 is the way your tax-free super income interacts with the low income tax offset and the seniors and pensioners tax offset, 2 separate mechanisms that many retirees have never even heard of. The seniors and pensioners tax offset, called SAPTO, is available to Australians who meet the age and income conditions for the age pension, even if they're not actually receiving the pension. For a single person, SAPTO can effectively raise your tax-free threshold to around $32,279 of assessable income. For a couple, it's higher still. Here's why this matters when combined with the first point. If your income in retirement consists primarily of tax-free super withdrawals, which are not assessable income, and a small amount of other income like bank interest, dividends, or part-time work, the SAPTO can reduce your tax liability on that other income to zero. In practice, many retirees drawing primarily from super after 60 pay no income tax whatsoever. Not because they're hiding income, not because they're using aggressive strategies, but simply because the system was designed this way. Tax-free super plus SAPTO means the average Australian retiree's effective tax rate on a comfortable retirement income is close to zero. Most retirees don't realize this until they sit down with an accountant. Some never realize it at all and continue lodging tax returns as if they were still employed, paying tax they don't owe. But here's what surprises people even more than the tax-free super and the SAPTO combined. The third thing the ATO allows after 60 is something called a transition to retirement income stream, or TRIS, and it works even if you're still working full-time. Most people assume you have to actually retire to access your super. That's not true after 60. A transition to retirement pension allows you to start drawing a pension income from your super from your 60th birthday onwards, while continuing to work in exactly the same job at exactly the same hours as before. Why would you want to draw from your super while you're still earning a salary? Because of the tax arbitrage it creates. Here's how it works. You salary sacrifice a larger portion of your salary into super, reducing your taxable income and therefore your income tax. Simultaneously, you draw a pension income from your TRIS to replace the take-home pay you've sacrificed. The pension income after 60 is tax-free. The salary sacrifice contributions go into super at 15% tax instead of your marginal rate of 32, 37, or 45%. The net effect is that your take-home pay stays roughly the same, but more of your money is flowing through super at a dramatically lower tax rate. For someone earning between $90,000 and $120,000 per year in their early 60s who still wants to work, a TRIS strategy can legally save several $1,000s in tax every year while simultaneously boosting their super balance before full retirement. The ATO has known about this and sanctioned it for years. Most working Australians over 60 have never heard of it. The fourth thing the ATO allows after 60 is the ability to make superannuation contributions, even after you've technically retired, and in some cases, without needing to meet any work test at all. Between the ages of 67 and 74, you previously needed to meet a work test, working at least 40 hours in any 30-day period, before you could make voluntary super contributions. From 1 July 2022, that work test was abolished for non-concessional contributions for those under 75. You can now contribute to super after retirement, after stopping work, without needing to prove you've been employed. Why does this matter? Because many Australians retire with assets outside super, savings accounts, term deposits, investment properties they've sold, or inheritances, and they want to get those assets into the tax-advantaged super environment. After 60, with the work test removed for most people, you can make non-concessional contributions of up to $120,000 per year, or use the bring forward rule to contribute up to $360,000 in a single per year. And if you're selling a family home you've lived in for more than 10 years and you're over 55, the Downsizer contribution allows an additional $300,000 per person, completely outside the normal contribution caps. For a couple selling a long-held family home, that's potentially $600,000 moved into super, tax-advantaged environment in a single transaction. The ATO allows this. Most Australians over 60 who are in this position don't use it. Number 5. And this one is specifically for people between 60 and 65 who are still working but thinking about reducing their hours. After 60, if you meet a condition of release, which includes things like retiring from employment, reaching 65, or even simply turning 60 and leaving a job, you can access your super as a lump sum or as an income stream while also reducing your working hours. This creates what financial planners call a semi-retirement strategy. Instead of the binary choice of working full-time or retiring entirely, you can move to part-time work, supplement your reduced salary with tax-free super income, and effectively maintain your previous standard of living while working significantly fewer hours. The total income, part-time salary plus tax-free super pension, can equal or exceed your full-time salary at lower total tax because the super component is tax-free. This option exists. The ATO permits it. But most Australians in their early 60s feel trapped in a binary. Either keep working full-time because they can't afford to retire, or retire entirely and watch their savings decline. The semi-retirement strategy is the middle path that the system allows but rarely promotes. The sixth thing, and this one is perhaps the most underused of all, is the ability to use the re-contribution strategy to change the composition of your super balance in a way that legally reduces the tax your beneficiaries pay when they inherit your super. Here's the background. When you die with super remaining in your fund, your non-dependent adult children, which in Australia means adult children who are financially independent, pay tax on the taxable component of your super at up to 17% inclusive of Medicare levy. The tax-free component of your super passes to them with no tax. Most people's super balances are primarily taxable component because contributions, employer contributions, and most of the growth inside super sits in the taxable component category. The re-contribution strategy works like this. If you're over 60, you withdraw a portion of your super, tax-free, as we established in point 1. You then recontribute that same money as a non-concessional contribution. Non-concessional contributions, money contributed from your after-tax savings, go back into super as tax-free component. By cycling money out and back in, you gradually shift your balance from taxable component to tax-free component. The effect on you in retirement is zero. You still have the same balance. the same income stream. But the effect on your adult children when they inherit is significant. They pay less tax on what they receive. This strategy is completely ATO approved. It requires some administration, and it is almost never mentioned to retirees unless they specifically ask. The seventh and final thing the ATO allows after 60, and the one that brings all the others together, is the ability to run what financial planners call a pension recycling strategy, using the combination of tax-free super income, ongoing contributions, and the pension phase tax environment. Here's the concept. After 60, you move your super to pension phase. Your earnings in pension phase are tax-free. You draw a pension income that covers your living expenses. If you have any ongoing income, part-time work, rental income, investment returns outside super, you salary sacrifice, or contribute some of that back into super as concessional contributions at 15% tax. The result? You're drawing tax-free income from super, living well, and simultaneously recycling some of that money back in at a lower tax rate, keeping the super environment working in your favor for as long as possible. The ATO permits all of this. In combination, these 7 strategies represent a retirement tax architecture that most Australians over 60 are simply not using, not because it's illegal, not because it's complex beyond understanding, but because nobody ever sat them down and explained it clearly. Consider someone. We'll call her Patricia. She's 63. She's been working part-time for 2 years after leaving a full-time role. She has $450,000 in super, still in accumulation phase. She has $80,000 in savings outside super from the sale of an investment property. She has adult children she wants to leave something to. Patricia currently pays tax on her part-time salary at her marginal rate. She draws nothing from her super. Her super earnings are taxed at 15% in accumulation, and her super balance has a predominantly taxable component that her adult children will pay up to 17% tax on when she passes. Now apply the 7 strategies. First, she moves her super to pension phase. Earnings now taxed at 0. Second, she starts drawing a pension income from her super to supplement her part-time salary. The pension income is tax-free. Third, SAPTO reduces her tax on the remaining part-time salary to near 0. Fourth, she contributes her $80,000 in outside savings as a non-concessional contribution, getting that money into the tax-free environment. Fifth, she salary sacrifices some of her part-time salary to shift remaining taxable income into super at 15%. Sixth, she begins the re-contribution strategy to gradually shift her balance from taxable to tax-free component. Patricia's total tax position changes dramatically. Her income is the same. Her lifestyle is the same. Her super balance grows toward retirement, and her children's eventual inheritance is structured to minimize their tax liability. None of this is aggressive tax planning. Every element of it is what the ATO's own rules allow an Australian over 60 to do. Patricia just didn't know about any of it. Here is what you should do now. Start with the simplest one. Number 1. If you're over 60 and you're withdrawing from super, confirm with your fund and your accountant that those withdrawals are being treated as tax-free. This sounds obvious, but tax returns are sometimes filed incorrectly, and it costs people money. If you're between 60 and 65 and still working, look into the transition to retirement income stream, the TRIS. Ask your super fund whether they offer one and what the process is to start one. Run the numbers with a financial advisor or accountant to see what the tax saving looks like for your specific salary level. If you have money sitting outside super, savings, term deposits, inheritance, ask your super fund about non-concessional contributions and check whether you'd sign re-eligible for the bring forward rule. The work test removal means more people are eligible than were before 2022. If you have adult children and you haven't thought about the taxable versus tax-free component of your super balance, ask your fund for a breakdown of your balance composition. Then look up the re-contribution strategy and consider whether it makes sense for your situation. And if any of these, the TRIS, the re-contribution strategy, the semi-retirement structure, the pension recycling, sounds complicated, find a financial planner who specializes in retirement income, not accumulation, Retirement income. There is a difference, and it matters. The Australian tax system after 60 is genuinely generous. The rules were built to support retirement. The super system was designed with tax advantages that compound significantly over time. The ATO is not hiding these advantages. They're in the legislation, publicly available, legally yours. The only thing standing between most retirees and these 7 advantages is information. You now have the information. If any of these 7 points raised a specific question about your own situation, put it in the comments below. And if you want to go deeper on any single one of them, particularly the TRIS strategy or the recontribution strategy, let me know which one, and I'll cover it in detail in an upcoming video. Your retirement deserves a compass, not guesswork.